The matching principle is a fundamental accounting concept that dictates how expenses should be recognized in financial statements. According to this principle, expenses should be recognized in the same accounting period as the related revenues they help generate. The goal is to accurately reflect the true financial performance of a business by aligning the recognition of costs with the revenue they help generate, allowing for a more meaningful representation of the entity's profitability. Key principles of the matching principle. Expense recognition. Expenses are recognized in the income statement when they are incurred and contribute to the generation of revenue, regardless of when the actual payment is made. This is in contrast to the cash basis of accounting, where expenses are recognized only when they are paid. Revenue and expense matching. The matching principle establishes a cause and effect relationship between revenues and expenses. It aims to match the expenses incurred in producing revenue with the revenue earned during the same accounting period. Periodic reporting. Financial statements are prepared for specific time periods, such as monthly, quarterly, or annually. The matching principle ensures that expenses are allocated to the relevant period to provide an accurate portrayal of the business's financial performance over time. How the matching principle allocates expenses. Direct matching. Direct matching involves directly associating an expense with the revenue it helps generate. For example, if a company sells a product and incurs manufacturing costs to produce that product, the cost of goods sold, COGS, is recognized in the same period as the revenue from the sale. Systematic allocation. In some cases, expenses may be systematically allocated over multiple accounting periods. This is common for certain types of costs, such as prepaid expenses or long-term assets, which benefit the business over an extended period. Depreciation. Depreciation is an example of an expense that is systematically allocated over time. Instead of recognizing the full cost of an asset in the year of purchase, the cost is spread over the asset's useful life, reflecting its contribution to revenue over multiple periods. Amortization and accruals. Similar to depreciation, amortization expenses for intangible assets and accruals for expenses incurred but not yet paid are examples of costs that are matched with the periods in which they contribute to revenue. Illustrative example. Suppose a company pays $12,000 for an annual insurance policy on January 1st. According to the matching principle. Direct matching approach. If the entire $12,000 insurance cost directly relates to the operations of the current year, the entire amount is recognized as an expense in the current year's income statement. Systematic allocation approach. If the insurance policy covers multiple years, the cost may be allocated systematically over each period covered by the policy. In this case, $1,000 would be recognized as an insurance expense each month, $12,000 per 12 months, to match the cost with the periods benefited. Significance and benefits. Accurate financial reporting. The matching principle enhances the accuracy of financial reporting by associating expenses with the revenues they help generate, resulting in more meaningful income statements. Decision-making. Users of financial statements, such as investors and creditors, can make more informed decisions when expenses are accurately matched with the revenue they generate. This supports better financial analysis and forecasting. Consistency and comparability. The matching principle contributes to the consistency and comparability of financial statements across different periods, facilitating meaningful comparisons and trend analysis. Legal and regulatory compliance. Adherence to the matching principle is generally required by accounting standards and regulatory bodies to ensure financial statements comply with accepted accounting principles. By following the matching principle, businesses aim to provide a more accurate representation of their financial performance, aligning with the underlying economic activities of the business and contributing to the reliability and transparency of financial reporting.